Well, welcome to the March webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined by Bob Paolucci, our founder and CEO. Bob, happy spring.
Yeah, good morning.
Good
Oh,
morning.
thank God for spring.
We're going to talk about that in a little bit, but the title of our webinar is Mixed Signals, which is to reflect some of the disconnect that we're seeing between the headlines and hard data. And so we do have, I'm going to share with you our agenda, Bob, that have changed the cadence just slightly, where we are going to talk about the markets, the economy and policy, and everything else, but we are sliding in a section called market anomalies.
Mhm.
And before we do this, we do want to address what has transpired over the last 4 days with the attack on Iran. And I think to kick that off, Bob, can we share first a couple of slides that address wars in general?
Yeah, I think once you put up those slides, they'll be very helpful. What you see, which is, shocking to most people that view it, is over the years, over a long period of time, this clearly illustrates that war is rarely a market event. The markets actually do quite well during these periods. It is usually the first week of adjusting what could and might happen, which we'll very likely see this week, where there's maybe outsized volatility. Um, but these are all of the geopolitical events through the years, and you can see that there's one major trend um, over the past almost 100 years is that market line goes up and to the right, and that's a rising market. If there are down markets on that chart, it's usually due to things like the Great Depression or the tech bubble implosion or the financial crisis. So ultimately, those tend to be drivers. Those systemic economic issues tend to be drivers of the economy and the markets, not war.
Right.
Yeah.
And and this data is going back 98 years. There are 35 geopolitical events on this slide, which comes out to about an average of one every few years. So unfortunately, they are common, and it's not to make light of anything that's occurred, but to your point, returns tend to be favorable during these times.
They do. Yeah. And these charts kind of speak for themselves. You see a bit of an increase in volatility. And I would say that volatility is usually due to the commodity complex, usually acting as a trigger to influence yields and stocks in a short period of time.
Mhm.
But outside of that, you do have actually pretty solid returns through these types of events through these periods.
Right. And I think getting a little bit more specific to Operation Epic Fury, there's some data here that I think is really intriguing.
Yeah, again, when you look at Iran specifically, they are a exporter of oil. Many call it pirate oil because it's non-OPEC oil, um, and the users of that oil, uh, uh, generally speaking, almost 80% of the oil bought from Iran is by China.
Hmm.
So this chart really does a great job of laying out who the buyers of Iranian oil are. And what you see here very clearly, the red part of the chart is China's allocation to Iranian oil. Um, there's some consistency here, and we'll show you the next chart,
Yeah.
which is the other thing that's in the news is the Strait of Hormuz, which is a big port for natural resources in the Middle East. 76% of the exports from there go to Asia. Only 7% come to us.
Amazing.
Again, if you question the importance of energy independence, question it no more. Um, we for the past 20 years wanted to try to avoid energy disruptions by becoming energy independent. Well, here we are, and thankfully we are here because this would be quite disruptive. Um,
Right.
so I think you tie a few things together. The fact that we, in essence, took over the Venezuelan oil. um, captured their leader. It then led to um, this happening. Um, it just so happens that the largest oil reserve in the world is in Venezuela, now in our hands, generally speaking. So I don't want to minimize anything, but I think any spikes in oil might be very short lived. I think Venezuela was part of this plan. And I hate to kind of blow past this. Certainly, Iran is the enemy of the world, the friend of none, the Ayatollah, the small administration that is evil Iran, of course, not the Iranian people. Um, but I think this is really a China strategy.
Mhm.
We'll cover more of that in the future, I'm sure. But this all leads to really cutting off China, whether it be the deal with Venezuela, whether it be the deal with Europe around Greenland,
Mhm.
um, whether it be pushing back on the friend enemies of the world, which happen to be a bit more friendly with China. I think this all points to putting pressure on the two remaining enemies of the world, and they are China and Russia.
Right.
So more to come.
I was gonna take your line on that. Darn it. Okay.
I'm
So,
sorry.
well, but aside from that, we did want to provide a perspective that you may not be seeing from mainstream media. As many of you know, that is a theme of ours. And so kind of moving into our agenda here and starting with the markets, we did want to kind of go back and go to this theme of mixed signals and talk about some of the narrative that's circulating relative to the facts that we're finding.
Yeah, and this was the title and one of the main slides prior to war breaking out in Iran. But ultimately, there are narratives circulating. I'm sure many of you, if you listen to this, you've heard them. The Fed independence is at risk. The facts are no. Kevin Warsh was picked. He was an ex-Fed member, kind of plain vanilla pick, emotionless, and wants to be in the background. Wants the Fed to be in the background, doesn't want to talk as much, willing to be very transparent, but doesn't want businesses to make critical decisions in short periods of time based on what the Fed may or may not do.
Mhm.
His point of view is we want to take more of a hands-off approach and only step in as and when needed. Um, and you should pay less attention to us. I think that's a very good thing. Another narrative is tariffs equal high inflation. Well, inflation has come down since tariffs were installed. Inflation now is at 2.4%. And a reminder to all that we are a services based economy and we are a services focused consumer. So we consume mostly services in this country, whether it be from here or abroad. And services do not have tariffs, goods do,
Right.
right? So when you do that math, you realize tariffs aren't as
Impactful.
impactful as you think.
Mhm.
You hear that corporations are borrowing more. Yeah, on a relative basis, sure, but we'll get into this later. They have record levels of assets, and the spread between assets to liabilities has never been wider. So
Right.
there's tremendous health, and a lot of that borrowing is to build things and to employ people and to create opportunity and to create uh, uh, more research and development, which equals better earnings, more efficiency, wider profit margins.
Right.
We've heard, I mean, Julina, as long as we've been in this industry, that the US dollar is going to be replaced by something else.
Some things don't go away.
I'm going to say that's sort of nonsense for anyone uh, who is listening to this. And that change is highly unlikely to happen anytime soon. I would say, if anything, it could be a generation away, maybe two. Um, but uh, in second place of the currency, who's next in line as a global currency is the euro, but they are miles and miles and miles and miles and miles ahead. Oh, meanwhile, didn't they have a debt crisis not too long ago? And aren't countries walking away from the eurozone like the UK? Yes. So again, I think these fears are misplaced, but people have to talk about something. The AI buzzsaw is going to replace everything. So right now, the AI narrative is turning uh, into a a negative narrative
Sure.
where industries and sub-industries are getting hit by the AI bug, like software, cybersecurity, and that AI is going to replace all jobs. It's not going to replace all jobs. I think the truth is AI usage is leaning heavily towards enhancement and assisting people
Yeah.
versus replacing. Um, I think taking a human who may have a mismatched skill set with what the job requirement is and gluing them together with a sharp AI tool creates a lot more productivity, efficiency, higher profit margins, higher output, higher earnings, and probably a better experience for all.
Right. Yep.
Yep.
What about private credit and this widespread problem it's creating?
So private credit, sort of the loan sharking of the capital markets, but outside of the capital markets, let's say, because it's private. It's business to borrower direct lending. A lot of these companies that are lending have put a bunch of loans in a pot privately. And because there's a demand for higher yielding investments, institutions are looking to invest in this stuff. Um, that has been going on for a long period of time. It used to be called what, shadow banking, shadow lending. Post 2008 financial regulations created the need to go outside of banks to borrow money and raise capital, so on and so forth. So private credit came along, created these notes, and now they're securitizing them still on the private side, not
Hmm.
on the public side, because this stuff is private and illiquid and not meant to be traded or priced and meant to be held to maturity. But like anything else, you blow past all the disclaimers, and some of these investors want some of their money out. And what they're finding is, hey, they're locked in to private securities that oftentimes aren't valued, that oftentimes can't or shouldn't be sold. And it's creating a news problem. And then there's some issues on the private side for companies that are involved in this stuff.
Hmm.
I don't believe this is widespread at all. It is generally speaking, a relatively small part of the private markets. Um, but it seems to be having a big impact on anyone who says they're exposed to private credit, uh, at least the publicly traded companies. So
Yeah.
I think there are some issues. We've been talking about this for years. We have zero exposure to this stuff, um, nor do we want exposure to this stuff. And I think the 10 or 20 companies or so that are heavily exposed, well, they'll just pay the price if something goes wrong.
Yeah.
So it's not as widespread as you think. Again, most of the stuff is owned by institutions, won't be sold, will let the loans run out, and they'll deal with whatever issues they have.
Sure. And maybe not to expose our confidence too soon, but if you take all that narrative and, address sort of the bottom of this slide, stocks are near all-time highs, profit margins are high and growing, earnings are at an all-time high, full employment, productivity is rising, the economy is growing above trend, current tax bill, spending bill is pro-growth. We're starting to see growth outside of the US. There's approximately $8 trillion in cash, and we have supporting documents that we're going to go through for the remainder of this webinar. Is that fair to say?
Yeah. What was it from the movie Dragnet where they said, just the facts, ma'am?
Yeah.
Right. So there's just the facts on the bottom.
Yep. There we go. So
Yeah.
let's share some of these facts and let's start with the markets and look at the earnings and how they're broadening out.
Yeah, all together now. So what you're seeing here is it's no longer just the Mag 7. We've been talking about this for a couple of quarters and expecting this. This is the proportion of S&P 500 companies posting higher earnings. So you're just above 75% of the companies within the S&P 500 that are now posting higher earnings, right? And you go back a year ago, it was somewhere in the 60%. You go back 2 years, it was somewhere in the high 50s. Now you have greater than three-quarters of the S&P posting higher earnings. That's great participation. We'd love to see that because that usually leads to higher stock prices throughout the S&P. And we're seeing right now about 60% of the S&P beating the S&P 500, where for a few years you've only heard, or we've only heard, and we saw that only a small percentage, the top 10 of the S&P, were outperforming the S&P and driving it higher. Now we have the opposite happening. Most of the S&P is outperforming the S&P 500, right? So that's good. That's a very deep, healthy market. That's a
Right.
very good thing to see inside of the equity market. Full participation, we call it.
Full participation, and then you hear a lot after a few years of strong growth in the market. Well, the market's more expensive. It's too expensive.
Right. And they're really talking about one indicator, one of a dozen that you should look at, but it's really the PE ratio.
Mhm.
So, okay, for all those that thought the PE ratio was high 3 months ago, look at it now. This in particular is tech, because tech is about 40% of the S&P 500. The earnings rate of tech has gone up dramatically. Let's call it over the past quarter or two, and prices have been maybe sideways, maybe slightly negative at best over the past quarter, maybe slightly positive over the past 2 quarters. But when earnings rise significantly more than price, you have lower valuations. You have a
Mm.
lower PE, therefore you have cheaper stocks. So what do we say? Bubble no more,
Sure.
right? So that's a good indication of what's going on that slide. To prove it further, to get granular, not a recommendation to buy or sell any securities on this slide. But long story short, consumer staples, known for their boring nature, stability, dividend increases, and consistent low earnings growth, are
Hmm.
now more expensive than most of the tech sector and most of the Mag 7,
Yeah.
right? So for most of the companies on the left, they are trading at the lowest valuation we've ever seen.
Yeah.
Um,
N-
you know,
not to nitpick, but Costco is double the valuation of Meta.
amazing,
Yeah.
right?
Yeah.
Just want to put that out there that consumer staples, known for their low valuation, tech, known for their high valuation. There's sort of been the opposite effect happening recently.
Right.
So
Right.
something that we're very mindful of.
So when you talk about the markets being more expensive a few months ago, it wasn't even as if those were at an extreme. They were just more expensive than the average.
Yeah, and what's also not factored in, which should be factored in, is other things, right? So PE ratio is one indicator. When you look at profit margins, if you ever have a scenario where you have very high profit margins, um, that encourages higher PE ratios. If you have low profit margins and high PE ratios, run for the hills. If you have very high profit margins and slightly above average PE ratios, it's very supportive of even higher PE ratios. So I don't really think there's a valuation issue. I think what we're seeing is profitability, profit margins are rising, and very likely through efficiencies and various other things, those profit margins will remain intact near the high end of where they are, where they've been, and potentially even roll higher, which ultimately means this market, from a valuation standpoint, has a some room to run.
Right. Absolutely. And as we talk about the S&P broadening, we talk about valuations shifting. It's interesting to see below the surface of the S&P what's transpiring from a return standpoint.
Another slide that illustrates sort of the participation in the market. There's a small segment of companies that are either up or down 5%, more or less than the S&P 500. Most of the companies are either up a lot more or down a lot more.
Yeah.
But there are more companies that are up than down. So, a lot of the movement in the market is hidden when you measure at the top line.
Right.
So the S&P hasn't really moved year to date, but there's been a lot of movement beneath the surface year to date. And that movement is the sectors that did well and subsectors that did well last year have cooled off. The sectors and subsectors that haven't done well in years have woken up. And that's where we're getting the participation from. So this is a very interesting slide.
Yeah, when you look at the orange, it's showing over 20% of the S&P is either above 20% or below 20% for the
That's right.
year to
So
date.
far, so
Yeah,
far.
amazing.
Yeah.
So that we talked about the S&P, but let's talk about what's going on within AI specifically.
Yeah. So when we talk about AI, we have to talk about it, right? wonderful slide that pulls out companies that aren't using AI, the S&P 500 glued together, and then isolating companies that do use AI. And what you're seeing is the profit margins on companies that use AI significantly higher
Mhm.
than the S&P, significantly higher than companies that don't use AI. So clearly, AI is having a positive effect on efficiencies and positively impacting profit margins.
Mhm.
Hence, why a lot of companies are now starting to spend money, plan for, and utilize these tools.
Right.
Yeah.
And the US is dominating this trend.
This is the spending chart of the U.S. spending on AI versus everyone else. Um, and ultimately, it's proving to be a generator of GDP growth, not just earnings growth.
Mhm. Yep. And let's talk about small caps.
We'll talk about small caps. We had some exposure last year. We moved out of most of it in favor of buying large, higher quality companies that were on sale right around tariff time, spring of last year. We still like some small caps, but we had a feeling that if there was going to be a continued rally in small caps last year, that it would be driven by the bottom tier companies, the lower
Mhm.
quality companies. Let's call them, what do they say, junk in English?
Yep.
And that's just not an investment style that we participate in. So we were okay with selling our small cap exposure, even though it was high quality. We felt like high quality large cap would outperform. What do you know? We were right. What has been running hot and higher in small cap is the bottom of the barrel.
Right.
I don't love to see that. I think there will be an opportunity to buy some high quality small caps in the not too distant future. Um, and I hope investors stay away from those zombie companies that take up half of the small cap indices
Mhm.
because they have run up um, really based on hope, not based on a lot of fundamentals. So just something to be mindful of.
And I think it's a great reminder that we're not here to chase short-term performance. There is a risk element that we also need to be mindful of when we're building out the strategies. So,
Mhm.
and let's talk about the international markets, which have been a little favorable.
So the U.S. versus the rest of the world. So last year, you actually had the first year in a long time where foreign markets outperformed the U.S. Yeah, true. Why? Well, they didn't really grow their earnings outside of the US. They just started the year cheaper. And there was also a currency move. So for those investors who buy foreign securities in the US using dollars, you have this sort of hedged move that created outperformance. Had nothing to do with earnings growth. The US had tremendous earnings growth um, and underperformed the foreign markets.
Mhm.
The hope is for the foreign markets that they actually have earnings growth because they are still cheaper than the US, but not as cheap as they were.
Mhm.
They have slightly higher dividends because they're cheaper. And if you add earnings growth to potentially a little bit more of a currency move, um, then you might have an opportunity for foreign stocks to do better than they have in quite some time. We shall see. Just keep in mind that with this war going on, however long it lasts, the major disruption is overseas, not here.
Correct. Yep.
So, what this might create is some price distortion. And if foreign securities drop enough, we like a sale here at Principal Wealth, Julina. We might find an opportunity to buy some foreign securities at a deep discount.
Absolutely. Okay.
We'll be watching.
We'll watch, and I think that's a good way to end the markets and transition over to the economy and policy. And we're kicking it off with consumer balance sheets, which again, we say it remains strong.
Well, we're saying it because we're looking at it.
Yeah.
We're not coming up with these ideas in our head. So what you see here is the spread of liabilities and assets of the consumer going back to interesting points in time. 1999 before the tech bubble implosion, 2007 before the financial crisis, 2019 before COVID, and then last year. And
Hmm.
what you see there is a trend where assets keep growing quite well and liabilities are not.
Correct.
So the asset to liability spread is incredibly wide. And that is a sign of a healthy consumer, not to mention the other thing we always talk about $8 trillion of cash on the sideline.
Correct.
Right.
Exactly.
Right.
And on top of that, the corporate balance sheet looks good.
Uh, if not better.
Yeah.
Corporate free cash flow,
Yeah.
that line goes up and to the right. Profits from production, that line goes up and to the right. Those look like all-time highs to me, Julina. And then a very impressive one down bottom is the spread between assets and liabilities for corporations. And there's a Grand Canyon between the assets and liabilities. That's quite a healthy spread, if you ask me.
Similar theme to the consumer
Yeah.
chart. Yeah.
Yep.
And let's shift and talk about policy with the trend from last year versus this year and the stimulus, excuse me, that can come from it.
Yeah. So this is tallying up uh, the effects of policy and putting a number on it. So you look at 2025, it was a little restrictive because quantitative tightening was wrapping up, but still happened. You had priced in a tightening effect from tariffs and some tightening through fiscal policy. With no measured change through financial deregulation. But in 2026, those negatives turn into positives. So there is technically almost a $1.2 trillion relative change in the impact of policy that's coming our way in this economy. And it's not going to be exactly that, but somewhere around that.
Hmm.
I would say that provides liquidity, that provides stability, that provides net stimulus. That really isn't talked about much. So the wind is at our back here economically.
Yeah. And I don't think I need to remind anyone that 2025 resulted in a positive year in the S&P as well,
Absolutely.
right? And so let's talk about yields across the curve and how they've lowered over the last 6 months.
Yeah, so the 6 month read, there is the diamond, which is the current read, and then there is that rectangle box with a string on it. That is the zone in which it was in over the past 6 months. And I can't find a diamond that is in the rectangle. What that means is across the yield curves, yields are low. The reason why we mention this is because the short end is sort of pricing in what the Fed's going to do. The middle part of this curve is directing mortgage rates to a degree, and the longest end of the curve, no one invests in, nobody cares, and it should be higher anyways. How about that? That's my bond class. But what you see here is makes a lot of sense, right? You have a scenario where short rates are coming down, where you have the Fed no longer um, uh, uh, doing their quantitative tightening throughout the yield curve. So they're no longer selling their bonds in the open market. They've stopped, generally speaking. They might even be buying some on the short end. And you have a scenario where yields are lower.
Correct.
You have inflation lower, yields lower. The next slide is really why we put that one in the lead-in slide, is from the Wall Street Journal on Friday. Mortgage rates dipped below 6% for the first time since 2022. So the 30-year dipped below 6%, which, mentally, I think for a lot of people, having a mortgage in the fives is very important, dipped for the first time. So, there are a lot more sellers than buyers nationally in the housing market.
Right.
And that usually leads to lower price. If you take a slightly lower price with lower mortgage rates, you're going to have a lot more activity. A lot of housing activity is additional stimulus activity that drives the economy higher. So these are good things.
Yeah. And despite despite tariffs being front and center of the news, inflation continues to be low.
2.4% CPI. Yep.
Yes.
And likely headed lower. You know, in a month, I don't know, in a
Yeah.
quarter, probably in 6 months, highly likely. Why do we say that? Well, this is a chart cherry picked that only looks at shelter inflation, measured stale, the normal way, measured live. And when you think about the lag that exists in the shelter number, there's about a year and a half lag when the data gets into the government calculation. It's going to continue to reflect that housing has cooled and rents have cooled. And this is a third of the inflation calculation.
Hmm.
So this is a big, heavy weight in the inflation number that keeps rolling lower and lower and lower and lower and lower.
Right.
This is why inflation's coming down.
Okay. When we talk about interest rates in the Fed, we still remain at full employment.
Yeah, the two mandates, inflation and employment for the Fed, well, we're at full employment, right? So the Fed gets sensitive to increases in the unemployment rate. They don't really talk too much about why. I think that narrative will start to change soon, and they'll start to dissect why there's maybe a little bit more unemployment. I think the why is twofold. Number one, AI is impacting some of the labor heavy minimum wage jobs, right?
Mhm.
Um, if there's any negative impact, it's going to be to those who have those jobs. That's number one. Number two, well, the government stopped hiring people. Private sector is still hiring,
Right,
right? Here are those numbers.
right.
Interesting charts,
What a
past 3 years.
shift.
Same data. That's government employees and private employment, past 3 years, past 5 years. That's an interesting chart um, to look at.
Yeah,
Um, and it's because the government hasn't hired as many people as they did over the past 5 years, 6 years.
right,
Yeah.
right. And now layer in AI into employment.
Yeah. And those who are worried about AI, replacing all jobs and removing all opportunity, you just have to remember that every innovative change uh, since this country has existed has created opportunity, and more opportunity every time there was an innovation change. And
Mhm.
ultimately, for everyone that is displaced because of new trends and technology, it creates an opportunity for other people,
Right.
right? Not to mention the skill set mismatch that was all the news over the past 5 years. Well, how about you take someone with the skills that aren't good enough to do a job and you glue together AI, and now you have this scenario where the job can get done
Mhm.
more, hopefully effectively and efficiently.
Yeah, absolutely.
Yeah.
And when you talk about AI and employment, it's hard not to look at the potential, the productivity boom that we may just initially be in. And when you compare it to the adoption of the PC back in the late 80s, the internet in the late 90s, early 2000, it's, again, I think we're just in the infancy.
Yeah, I mean, when you look at this chart, you just question why we've been so inefficient. I'm going to say if we put a chart of when smartphones and iPhones and social media rolled out uh, on there, it would help articulate why businesses aren't as efficient as they should be. And so I say, hey, maybe if you're a business, thank God for AI because it's making your employees a little
Mhm.
bit more efficient, your business more efficient. I think we're early in on the productivity curve. I
Mhm.
think that arrow keeps going higher.
Yeah, yeah. And finally, let's address what we probably would have started our webinar with a few days ago and talk about tariffs and the update with the IEEPA being struck down.
Julian, I almost forgot. So tariffs got struck down by the Supreme Court. And in essence, what they said is, yeah, it's okay that you do it, but you chose the wrong tactic, the wrong path to do it. You should have done it via some other ruling. Let's just go right to that.
Mhm.
And uh, what has happened is there's been a change to tariffs using Section 122, which technically are temporary, and you see the net change with Section 122, and that equals in aggregate a lower tariff rate. The next slide, Julina, really breaks it down.
Mhm.
So the new global tariff under Section 122 really can only be set for 150 days. It's set at a 15% max rate, and it's sort of a loophole. Now, the question is what happens after 150 days? After 150 days, it's very unlikely that Congress will get this. And if they do, they will act like they didn't get it because we have a midterm election on our hands. So, I think the question by many, us included, is uh, will the administration be able to install another 122 for an additional 150 days, 130 days from now? Well,
Hmm.
we're going to find out, aren't
Hmm.
we? So to me, we're either going to fall back to a much lower tariff rate. And I think without Section 122 and those non-IEEPA tariffs, you're probably looking at about a 6.5% rate. I would say that's the base case after Section 122 expires somewhere around midsummer.
Yeah,
But we're going to find out.
right. I think either way, it's continuing to prove that these tariff concerns, as we've talked about for a long time, are not transpiring into higher inflation and the economy is still robust.
Yeah.
So, yeah. So we're going to transition to, we slid into the agenda this market anomalies category and really to address the private credit and the pain that we've been seeing there.
Yeah, and again, just the last point on private credit, we wanted to put this one in the back because it's here are some of the companies involved or claim to be involved, and how their stock prices have doing. Remember, a lot of these creators of these products are publicly traded. These are the ones within the S&P 500, and how they're doing. They're not doing great. Why? Really the issue that they have is a lot of their um, loans are just software, and software has been getting hit with the AI buzzsaw, we call it,
Right.
right? Um, Saying that, hey, software is no longer needed because AI can code and replicate and create stuff more efficiently in a more exact way for you, the user, or you, the company. Um, I don't think that's exactly the case. Seeing that if you look out into the private hiring world, a lot of the job postings are for software related people. Um, those postings have increased, not decreased. Number one. Number two, a lot of the fear, there's a lot of fear going on, has been baked into a lot of these companies. So it really seems to be isolated to software. Um, so again, I think this too shall pass. I think this is living in the institutional world. A lot of the publicly traded companies, their stock price has already been impacted. This proves to you, this chart, that a lot of this private credit stuff lives in the institutional side with maybe some exposure over the past couple of years to retail, usually through brokerage houses that are commission based to sell you products that you don't need, don't want, and don't understand. Um, More to come on that.
More to come.
Yeah.
And finally, this everything else topic that we like to end with.
Yeah, so intraday ranges in the market, bottom right hand slide, showing the spread high to low for a day, and then a 5 day moving average. You could see on the left side that's spring. On the right side, those spikes are usually fall, somewhere between October and November. We're right in the higher volatility stage of the market. That's a good indication of last year, bottom right. But on the top left, daily equity turnover. Average US daily equity market turnover is $1 trillion a day. The buying and selling is $1 trillion a day. Now, we don't have a slide in there that shows is it machine trading or individuals? Well, it's a combination of both, but the vast majority of it is machine trading. So, you know, this is why you can't look at the markets for uh, a day or a minute or a 30-minute span. You
Yeah.
have to take a slightly longer horizon because the manipulation done by algorithms and machine trading and day trading and margin calls and systematic stuff that happens that has nothing to do with fundamentals of a company. Like rumor is priced into this, tweets are priced into this. Um, you have to zoom out and measure over a much longer period of time. Otherwise, you'll be unable to make money or invest in the markets, nor will people be willing to have a conversation with you. Because if
Right.
every second you're distracted by this nonsense, it, it, it drives you crazy. Uh,
Absolutely. And the fact that it's doubled in less than 10 years, I think everyone needs to be very cognizant of the fact that this is a common occurrence.
yeah,
Yeah.
yeah,
Okay.
it happens more and more. I mean, look, the markets are bigger, so it tolerates it,
Right.
but also this stuff grows along with the markets. So
Correct.
just be
Yeah.
mindful of that.
Yeah. And it doesn't feel like we're approaching spring, but it's a great time to remind people that we have to get a little bit more organized, and especially as it relates to estate planning in our mind.
Yeah, did you mean because we're buried in snow here in the Northeast, Julina? Yes. It's spring cleaning time, and it's a good reminder to get your estate plan in order and or to create one if you don't have one. Things like, who's going to make your medical decisions, and if you have someone named, do they know they're named? Do you have a document, and is it signed? Choosing a trusted person, either as a trustee or an executor or power of attorney, healthcare power of attorney. Make sure your paperwork is up to date. Have you valued your assets? If you work with us, we can help you do it, or we've done it for you already. Decide how the assets will be divided, create a succession plan for your business or real estate, work with an attorney. In most states, you have to have an attorney draft and sign off on these things.
Right.
And if you have any life insurance and long-term care insurance, is it owned properly through the right entity, individually, jointly? There are a whole bunch of things you have to think about.
Well, I think this is a very overwhelming topic. I mean, even if someone has created the appropriate estate plan, as life goes on and time goes by, it needs to be updated as well. And so I guess the question I would ask you, Bob, is how can Principal Wealth help in all of these steps?
Well, we have now a fiduciary services department at Principal Wealth where we can help our clients analyze, review, and dig into the details of their financial plan and or help articulate what their estate plan really looks like and maybe should look like. And then we can help you either work with your attorney to help make modifications or get you in touch with a qualified attorney to help create the estate plan. So there's a lot that we can do now, and many of you have taken advantage of these services that we provide. And for those that haven't, maybe you are unaware of it, we'll make you aware of it, hopefully through this mode and with our advisors talking to you directly about it. So keep in mind, a very important thing to do. And when you do your spring cleaning, it's a good time to remind yourself that you should check your documents, check your will, check your beneficiary forms to see, if you need to make any changes. And of course, if you're working with us, we help you do that along the way. But it's something very important to be mindful of.
Yeah, and one of the things I love, I think a lot of our clients, maybe they came from other financial advisors, or maybe this is the only experience they know, but I can tell you that I worked with thousands of financial advisors in the Northeast for over 20 years before coming to Principal Wealth. And Bob, I joke with you, I can't even count on one hand how many other advisory firms are offering this. So we encourage all of our clients, if you haven't taken us up on this, this is a very unique way that we can continue to add value, and that's what we're always looking to do. So
Absolutely. Thank
yeah,
you for that.
and we have no more slides.
We're done.
That's what we get for
Yeah.
that's what we get for changing so many slides over the last few days and changing the order. So sorry about
Yeah.
that.
Yeah. We're done. That's great.
Yeah, we were going to end with a visual of how much snow was in the Northeast in Connecticut, but I think it's more important that we ended with the estate planning. So
Yeah, and keep in mind, obviously, we're dealing with the world is dealing with the war in Iran, and there'll be some market inefficiencies to come. We will be watching for sure, as we always do. The day one reaction in the market was quite tame. The market's actually closed up on the day. Day two looks like there's a lot more volatility. A lot of that is coming from South Korea, who owns a large portion of the U.S. stock market, needing some money. So every once in a while, they sell some securities. Don't be fooled. So more to come on that. Of course, we're watching. We will take advantage of what we think are bargains if bargains are created through this. And if not, then we will remain invested the way we are in our high quality securities. So if you're watching this, just understand that we always watch these things and we take advantage when we find the proper opportunity.
yeah, absolutely. In fact, we're pushing this webinar out just a few days early, given everything that's transpired. So I hope that our clients understand that we are constantly watching. You will be hearing from us again next month, as always. But if you have any questions, if you have concerns, you can always reach out to any of us at Principal Wealth. And Bob, as always, thanks for your insight and looking forward to a real spring webinar in April.
That's right. See you next month.